Hey guys, I hope you're doing well. So welcome to this session of the APM. And as mentioned earlier, that the session of today is going to cover up the economic value added, which is one of the important areas of the advanced performance management syllabus. Before I start off, let me introduce myself. My name is Luqman Rafiq, and I've been in teaching profession for more than 14 years now. And I've been teaching different qualifications, including the ACCA, ICAW, ICAP, ICMAP, CIMA, CMA USA, etc. Different type of qualifications. And I teach different subjects, including the financial management, the business, strategic business reporting, the performance management, the advanced performance management, the audit and assurance. So the different type of subjects that I actually do handle. So what are we going to do in today's session? We are actually going to start discussing about the economic value added. We will discuss how the economic value added is calculated, and we will try to do some of the questions on the economic value added. A lot of students have got a query that will the recordings for this session be available? Yes, the recordings for this session will be available. How would I be teaching this session? I would actually be teaching from the scratch. I'm assuming that you people are have not studied EVA, even though you might have studied EVA. But my assumption is going to be that you have not studied economic value added. So that's how I'm actually going to be taking it to. So in case if any one of you has got any questions as you progress through, you are most welcome to ask them and I'll be happy to answer. Okay, so let's start off. The topic that we are discussing is called economic value added, which is also known in the short form as EVA. Now let's talk about the economic value added. Before I go on to discuss economic value added, we know that when we measure the performance of the organizations, there are different type of financial performance indicators. And amongst those financial performance indicator, one of the performance indicator is quite known and quite common, and that is called residual income. What exactly is this performance indicator of residual income? The performance indicator of residual income is usually used in the cases of divisions, where what we do is that we say that divisional profit minus desired return percentage multiplied by investment. So when we talk about the concept of residual income, the concept of residual income is the divisional profit less the desired return percentage multiplied by the investment. So let's say, for example, if I talk about a business having a divisional profit of 100,000, and let's say if I say that the business has a desired return percentage of 10%, and the investment in this business has been, let's say, $800,000. So hence resultingly what happens is you would say 100,000 minus $80,000 gives you $20,000. Gives you $20,000. This is actually going to be considered as residual income. This is actually going to be considered as residual income. Now, so 20,000 is your residual income. Now, what does this residual income of 20,000 actually means? This income of 20,000 actually means that this is the excess, this is the extra amount that the business has earned over and above the amount which is desired by the providers of finance or desired by the investor. The business has earned extra amount. Now, so whenever we talk about the concept of residual income is being one of the method that has been used in the divisionalization, and the major objective and the major agenda of using the residual income is that the residual income helps you evaluate that how much extra a business, a division, a branch has actually earned. Now, the problem with the residual income is that the residual income has got certain limitations. I repeat, the residual income has got certain limitations. Now, what exactly are the limitations that the residual income has? So let me just guide you a bit about it. When we talk about the residual income's limitations, the limitations that the residual income has is that the profit that is being used, the profit is subject to the accounting rules and regulations. The profit is subject to the accounting rules and regulations. So the accounting rules, accounting regulations, they differ. And when the accounting rules and the accounting regulations, they differ, the resultingly impact of this is that, I repeat, the resulting impact of this is that basically the profit does not actually reflect the actual performance of the organization. Like for example, you have got the issues with the accounting for the intangibles. At times there is this, the depreciation and the use of the estimates, all of them are impacted by how the accounting standard tell you how to account for it. So number one point is, whenever we talk about the divisional profit, the concept of divisional profit is that the divisional profit is impacted by the rules and regulations that are prevalent as per the IFRS, and they may not actually reflect the financial performance of the organization. The secondly, the additional issue that happens is that the desired return. Now you see, I'm an investor. I'm saying that I need a return of 12%. I'm saying I need a return of 20%. My request to have a return of 10%, my request to have a return of 20% doesn't actually make sense. Now, why is it, why does it not actually make sense? The reason that it does not actually make sense is that the providers of finance may actually be asking for 8% return. The providers of finance may actually be asking for 9% return. My WACC is 9%, but as an investor, I want 20% return from my division. So that's an unreasonable return. So basically the desired return is, again, it could be unrealistic. The desired return could also be unrealistic. The third thing that you need to keep in mind is basically about the investment. About the investment. The investment actually refers to capital employed. The investment actually refers to capital employed. And whenever we talk about the concept of capital employed, the capital employed keeps on changing depending upon what has been capitalized as per the accounting rules, what has not been capitalized as per the accounting rules. So again, it is also impacted by the accounting rules and regulations. So it is also impacted by the accounting rules and regulations. That's what actually happens with respect to the capital employed also. Now let's move a bit forward. So in order to overcome these limitations, the concept of economic value added was introduced. The economic value added which is the EVA, is actually derived from the concept of residual income. And the formula for the EVA is basically NOPAT minus WACC into capital employed. I repeat, when we talk about the economic value added, the formula for the economic value added is NOPAT minus WACC into capital employed. NOPAT minus WACC into capital employed. Now, what is it, this NOPAT? What is this WACC? What is this capital employed? Let's have a discussion about it. So when I talk about this NOPAT is net operating profit after tax. Remember, as I mentioned about the limitations of the residual income, this EVA, the economic value added, actually overcomes the limitations of the residual income. What are the limitations of the residual income that it actually overcomes? The limitations of the residual income that it actually overcomes is that includes the different problems that arise because of the accounting rules and regulations. So I'm going to discuss in detail what exactly is that. Then WACC. WACC is your weighted average cost of capital. What is this WACC? The WACC is your weighted average cost of capital, which is the average return which is desired by the providers of finance. And then capital employed. The capital employed is again calculated and adjusted in accordance with the EVA rules. So the capital employed, generally what happens is that when we talk about capital employed, the capital employed is total assets minus current liability. That's one of the ways. Or what you could do is that you could say it is equity plus non-current liability. So this is what it is going to be, either the total assets minus current liability or the equity plus non-current liability. That's what the capital employed is. So now what I'm actually going to do is that I'm going to tell you people, I'll discuss each one of the aspects one by one, and I'll explain to you how the economic value added is calculated. But before I go on to calculate the economic value added in detail, let me just guide you. If the EVA is positive, that means the value has been created for the shareholders. If the EVA is 0, that means no value created. And if the EVA is negative, this actually means that the value has been deteriorated. When the EVA is negative, the negative EVA would actually mean that the value has been deteriorated. Now, furthermore, usually what happens is that when we calculate the EVA, we calculate over a period of time, like maybe possible. We're calculating EVA for 2022. We're calculating EVA for 2021, things like that. So let's say if you have got a EVA for 2021 to be, let's say, 10 million, for 2022 to be, let's say, 9 million. Now, what does this mean? This actually means that the value is created in both the years. I repeat, the value is created in both the years. But basically what has actually happened is that, I repeat, the value has been created in both the years. But what has actually happened is that the value created in 2022 is lower than the value created in 2021. So obviously in 2021, you created a value of $10 million. But in 2022, you have created a value of $9 million. So the value created is different. I repeat, the value created is different. So when we talk about the economic value added, the result of economic value added could be interpreted like this. If EVA is positive, value created. If EVA is 0, no value created. If EVA is negative, value has been deteriorated. If over a period of time you are comparing EVA, and if the EVAs have been positives, but obviously the values could fluctuate. So it was 10 million in 2021, it's 9 million in 2022. That means value has been created in 22, but a lesser value is created as compared to 2021. Now, before I go on to discuss one thing, there is a question that I would like to ask you people, that when we calculate the NPV, which is the net present value, whenever we have the cash flows under the net present value calculation, under the cash flows, what we do is that we don't actually show interest. Now, can any one of you guide you that why exactly we don't show the interest? It's been included in the WAC. Okay, anyone else? Yeah, anyone else? Any inputs?
Is it because it's already included in the finance charge?
Yeah, it's already included in the finance charge. Okay, now see what happens is that when we do prepare the cash flows, so we actually discount them using the discount factor. So when you discount the cash flows, you end up getting the present value. So this discount factor is basically like your 10% discount rate or 12% or whatsoever. It actually includes the cost of capital. So whether that's the debt that you have or whether that's an equity that you have, everything that you have, it's actually included in it. Is that okay now? Now, basically what happens is that, so it's included in here. So if we include the interest in the cash flows also, then this would actually have a duplicate impact. This would have a duplicate impact. So we don't incorporate the interest in the cash flows calculation. Now, similarly, come in here. When you are calculating EVA, so you've got NOPAT minus WAC into capital employed. That means whatever the profit is, let's say whatever 10,000 or whatever the profit is, minus 10% multiplied by whatever this capital employed is. So resultingly what happens is that from the capital employed, we're deducting the cost. From the capital employed, we're deducting the cost. You get my point? Now, if we are deducting the cost from the capital employed, so this NOPAT, this profit should not actually include the interest. This profit should not actually have the interest expense. I repeat, the profit should not actually have the interest expense. You get it? The profit should not have the interest expense because otherwise it's going to be double counting. So just like when we avoid it in the NPV calculation, so in the EVA calculation, this NOPAT would not include the interest expense. Now, I've explained this concept. Now what I'm actually going to do is that in order to explain to people a NOPAT, I'll just create a sample profit and loss account for you people. Sales, cost of goods sold, expenses, profit before interest and tax, interest, profit before tax, tax, profit after tax. Now, when we talk about the net operating profit after tax, NOPAT, what we generally do is that we start off with profit after tax. Then we add back after tax interest. What exactly is this after tax interest? After tax interest is interest expense multiplied by 1 minus t. Then what actually happens is that accounting depreciation is added up. Economic depreciation is deducted. Non-cash expenses added up. Now let me just guide you. When we talk about the NOPAT, this is what you need to calculate with respect to NOPAT. You start off with this profit after tax, which is here. You add back the after tax interest to it. The accounting depreciation added back, the economic depreciation deducted, non-cash expenses added back, other adjustments are there. Other adjustments could be, it could depend upon a lot of things. Now, let me just guide you something. Basically, what are we trying to achieve? We are trying to achieve cash flows. We're trying to achieve cash flows because we know one thing, that it's always better to calculate cash flows as compared to use profits. I read, what are we trying to do? We're trying to calculate cash flows. Why? Because it's always understood that it's better to use the cash flows as compared to using the profits. Now, what are we doing? Let's say this was 50,000. Let's say this was 10,000. So you had 40,000 PBT, the tax was at 40%, let's say. So this was 16,000. This actually gives you 24,000. What does it give you? It gives you 24,000. Now let's try to understand something. If you have got profit after tax of 24,000. Now what is it we need to do? We need to remove the impact of interest from it. We need to remove the effect of interest from it. And if we are going to remove the impact of interest from it, ultimately what's going to happen? Ultimately what's going to happen is that the tax savings would arise, right? Because the tax savings would be lost. The reason being, when you have an interest expense, the tax becomes low. But when you don't have an interest expense, the tax becomes higher. So what are we going to do? We're going to add back after tax interest over here. Let's say in this case, the interest is 10,000. So it's gonna be 10,000 into 1 minus 0.4 gives you 6,000. Then what actually happens is that the accounting depreciation. Now let me just guide you what's the difference between accounting and economic depreciation. Let me guide you. You see, when we talk about the life of the asset, there are two lives. One of them is a useful life and the other one of them is economic life. The useful life and the economic life, what exactly is the difference between these two? Like for example, I purchased a car and I'm saying that I'm going to use this car for a period of 5 years. So if I'm going to use this car for a period of 5 years, my useful life is 5 years. What's the economic life? Economic life is maximum period over which this car could be used. Let's say manufacturer says it's a 10-year life. Let's say the manufacturer says it's a 10-year life. Now let me just guide you a bit. Let me just guide you a bit. Basically what happens is that there's a useful life, there's an economic life. So the accounting depreciation, what we do is that if let's say if I've got an asset of $10,000 and if I say life is 5 years, so $2,000 is going to be the depreciation. But realistically, the value of the asset has gone down by only $1,000. Realistically, the value of the asset has only gone down by $1,000. You get my point? The value of the asset has actually gone down by $1,000 only. So there is an economic life, there is a useful life. So what happens is that the people who have developed the economic value added, they say that, look, you've charged a depreciation of $2,000. You've reduced the profit by $2,000. Add it back, add it back, add back this $2,000. And when you add back this $2,000, so what you do is that you deduct the $1,000, which is the actual. You add back this $1,000, which is the actual depreciation, which is the realistic depreciation. So you see, what do? We actually add back the accounting depreciation and we deduct the economic depreciation. Is that okay now? Now, what else happens is that whatever the non-cash expenses are, like non-cash expenses could include impairment, provision for bad debt, deferred tax, etc., etc. That is all added up. That is all added up. Is that okay now? Now, then if there are any other adjustment like, for example, I'll give you one of the example. Let's say that when we talk about the marketing expense is not capitalized as an asset. I mean, the marketing expense is not capitalized as an asset. Why is the marketing expense not capitalized as an asset? Let me just guide you about it. The marketing expense is not capitalized as an asset. The reason being that uh, that basically the IS 38 says that it cannot be capitalized. But practically, the marketing can give you benefit for more than a year. So it can actually give you advantage for more than a year. So ideally, it should be capitalized as an asset. So the people who are the proponents of the economic value added, I repeat, the people who are the proponents of the economic value added, what do? They suggest that these marketing expenditures are not the expenses. They should be capitalized as an asset and they should rather be amortized. You get my point? So whatever the marketing expense, etc., there are some other adjustments also. They are added back. And what do we end up getting? We end up getting the NOPAT. So this is how one of the aspects of the economic value added calculation, which is the NOPAT, is calculated. Which is the NOPAT is actually calculated. Okay, let's move a bit forward and let's discuss about the next aspect of this economic value added. The next thing is basically you need the weighted average cost of capital. So if I could just recall, you have already studied the WACC earlier in your studies, but if I could just recall the formula for the WACC, it's like this. It's KE multiplied by E upon E plus D. Plus KD 1 minus T multiplied by D upon E plus T. Where what happens is KE is cost of equity. The capital E is market value of equity. Capital D is market value of debt. KD is the cost of debt. T is the tax rate. And KD1 minus T is termed as after tax cost of debt. At the APM level, I can guide you one thing. You don't have to worry about that. How would I calculate KE? You don't have to worry about how would I calculate the KD and so on and so forth. It's not a financial management paper. It's a performance management paper. So when it comes to the performance management paper, you don't have to worry about all these things. The reason being that the examiner is going to give all these things to you. I repeat, the reason being that the examiner is going to give all these things to you. So you don't have to actually worry about it, right? So this is what it is going to be with respect to the VAC calculations. Now, the last aspect of this is the capital employed. Now, what do we mean by capital employed? So let's just talk about the capital employed. The concept of capital employed here is that there are two things that you need to understand. Basically, the capital employed, it's total assets minus current liability, or equity plus non-current liability. So when I talk about the capital employed, it could be total asset minus current liability, or it could be equity plus non-current liability. Now, in the EVA calculation, one thing that you need to understand is that we are going to adjust the capital employed, but it's the opening capital employed that you have to use. Like for example, if you are doing the EVA calculation for the year ended 31st December 2022. So what would happen is that the profit that you are going to use is from the profit that you're going to use is going to be from 1st January 22 till 31st December 22. I repeat, the profit that you're going to use is going to be from 1st January 22 till 31st December 22. But the capital employed that you're going to use is going to be 31st December 21, or which we also say 1st January 22. You get my point? It's the opening capital employed that you're going to use. I repeat, it's the opening capital employed that you're going to use. Now let's move a bit forward and let's discuss a bit further. So when we talk about the capital employed calculation, you would do as per SOFP, the balance sheet. As per the balance sheet, you will pick up the opening figure and then you would do all the adjustments. You'd say accounting depreciation to date. Since the start of the company till now, whatever the accounting depreciation is, you got to actually add up the accounting depreciation to date from the start till now. Why? Because we are just gonna make it synchronize with the profit and with the capital. The economic depreciation to date needs to be deducted. The non-cash expenses to date. Now, what is this date that I'm talking about? I'm talking about this date. This date. So I'm talking about this date, the start of the year. Then what actually happens is you would say non-capitalized expenses to date. Like at times what happens is that you think that the marketing expenditure is going to give you benefit for more than 1 year. So if it's going to give you benefit for more than 1 year, you should actually add it up to the capital employed rather than expensing it out. And lastly, you would have non-capitalized leases. Now let me just give you a bit of an idea about what a non-capitalized leases is all about. When I talk about the non-capitalized leases, when we talk about the non-capitalized leases, the concept of non-capitalized leases is, like now there's this IFRS 16 leases that has been introduced, but earlier the IFRS 16 was not there. So if the IFRS 16 was not there, so what used to happen is that what used to happen was um, what used to happen was that there was an operating lease, there was a finance lease. The operating lease was not capitalized as an asset. The finance lease was capitalized as an asset. Now, if I talk about the operating lease and the finance lease and so on and so forth, so let me just give you a bit of a guidance about it. Basically, what's going to happen? What's going to happen is that you would have to understand this point, that the asset which has been purchased under the asset which has been purchased under the which has been obtained under the operating lease is not being shown as an asset in the balance sheet, but actually you are benefiting out of that asset. Actually you are benefiting out of that asset. So if you are actually benefiting out of that asset, so resultingly you should be capitalizing it. Resultingly you should actually be capitalizing it, but unfortunately it was not capitalized earlier. But nowadays, what has actually happened is that we have got IFRS 16, so it's actually capitalized. But in case if the question comes where there is a non-capitalized leases, you would capitalize it. You would include the amount in the capital employed figure. So this is how the EVA is calculated. I'm going to demonstrate this EVA calculation through one of the past examination questions, so that you people could have a good idea about how do we talk about the EVA calculation. Let me just take it through. Okay, it's one of the past examination question of this APM. And here the question of them is basically the use of economic value added as the key performance metric at IC. Now, what is he asking? Let me just see. There was this question where the economic value added has been calculated by the examiner, and he probably wants some adjustments, some amendments to the EVA. He says the CEO wants your views on the use of EVA as the key performance metric at IC. Obviously, we're not going through the other parts of the question. You've been supplied with the current EVA calculations, but there is some doubt about whether the junior management accountant who has done this work was sufficiently trained in the method. So probably the junior accountant has made some errors while calculating the EVA. So you probably have to rectify those errors. So he's asking you that the junior accountant might not have been sufficiently trained. Now, what else does he say? He says that therefore the CEO requires you to evaluate its accuracy and the assumptions which form part of the calculation, advise her on results, providing the calculations as needed. So they've done the EVA calculation, but there are doubts on the EVA calculation that has been done. So what we need to do is that we need to rectify the EVA calculations and we need to actually guide them accordingly. So the question is in front of you guys right now. I'm just gonna give you 5 minutes time. You could just look at this question and you could try to rectify the EVA calculation. I'm giving you 5 minutes time. So let's just try to do this. It says that the economic value added has been calculated. We just need to see that if it is done correctly or not. The operating profit has been done 551.4. Then it says add back non-cash expenses, marketing capitalized, less tax, lost tax relief on interest, so on and so forth. Capital employed is there, adjusted capital employed, assumptions and notes, etc. etc. Now, what am I actually gonna do? I'm gonna say I know this thing that the operating profit actually means PBIT. So we've got iron chicken. There's this NOPAT calculation. There's this capital employed calculation. So when you have got the operating profit, it's PBIT. The operating profit that you have is 551.4. Now what actually happens is that let's try to see things. It says debt to equity is 100%. Debt to equity is 100%. That means debt upon debt plus equity is gonna be 1 divided by 1 plus 1. That means 1 upon 2. The cost of equity is 30%. The tax rate is this. The cost of debt pre-tax is this. So if I try to calculate the WACC in this scenario, it's actually going to be what? The cost of equity is 16%. Multiply 1 upon 2 plus the KD. KD is what? KD is 6.8%. But it has to be 1 minus T. Do you have a tax rate in here? Yes, we have been given the tax rate here of 30%. Hence, resultingly, what happens is, let's try to see. The WACC is 10.38%. So what they have done is they've calculated an incorrect WACC of 11.4%. The WACC has to be 10.38%. I repeat, the WACC has to be 10.38%. What is the WACC supposed to be? The WACC is supposed to be 10.38%. Now, what next is there? Next, it says that there has been 23.1 million of marketing expense, etc., etc. I'm just going to go about it. So I've got the NOPAT 551.4. Now it says add back non-cash expenses. I'll just come on to that, but let me just sort out the things. There has been 23.1 million of marketing is spent each year for the last 2 years in order to build the brand of IC long term. So what would happen is that the marketing cost in each of the last 2 years, like the current year and the previous year. What is it? For the last 2 years. So last 2 years means current year and the previous years. So it's actually gonna be 23.1 that needs to be added back. For the capital employed, the marketing cost needs to be added back. Now you need to understand that was the marketing expenditure done in the current year, or I mean like current year and the previous year, or for the past 2 years and then current year. So what is your interpretation? What I'm assuming is that it's basically spent each year for the last 2 years in order to build the brand of IC. So my understanding is that it has been spent since the previous year and the year before that. So what is going to happen is that 23.1 multiplied by 2, 46.2. Then it says the tax paid in the year was 130 million, while the tax charge per the accounts was 134.8. So what happens is that the tax paid, you don't have to say this much, you have to say this one. Then it says the interest charge in the period was 81.6 million. So we don't actually deduct the interest, but we obviously do understand the after tax. We do actually know this thing, that if the interest expense is not deducted, then you end up paying, basically you lose this tax relief on the interest. Loss tax relief on interest. 30% multiply by 'Then it says the only research and development spending identified in the last 5 years was 10 million expense during this year on a new product. R&D cost 10 million has to be added back. The product has not been launched yet. The capital employed during the period was this. The opening is this. Change in the period is this. As per SOFP 2282. Now come back to whatever the things are there. Then there are these non-cash expenses. Which need to be added back. 15.1. Marketing, we have already handled. The loss tax relief, etc. Everything we have done. Okay. So resultingly, you have got the notepad. And this is the adjusted capital employed. $494.08. 2328.2. So if you want to calculate so resultingly the EVA is gonna be 252.4 million approximately. So I paid the EVA is gonna be 252.4. What is the EVA is gonna be 252.4. Kindly look at it and let me know if you all are okay with this. In case if any one of you have got any queries, any questions, do let me know.
Yes, Lukman.
Yeah,
Ricky.
yeah, Siddiqui,
My
please.
question is, why are we multiplying the marketing cost by 2 for the capital employed?
Okay, because my assumption is that it has been incurred for the last 2 years. I mean, like this is the third year. That is what I have assumed. So it's actually to date because whatever the marketing cost that has been expensed out to us, that has been incorrectly expensed out, should have been capitalized.
Hello, Lukman.
Yeah.
Maybe just to add on what my colleague has already asked, will it be wrong if we assume that 23.1 on market cost should remain the same when computing capital employed?
Okay. Now, one thing that I would like to add is that when I actually do the questions in the class, I don't actually, I mean, like I try to actually do it as a random feeling. Like I don't look at the solution before the class. I don't know what's the solution for this question. But the reason that I don't look at the solution is that I want to read the question just like a normal student would read, right? So again, I don't know what's the examiner's interpretation. My interpretation is that it's basically being incurred for the last 2 years, which doesn't, I mean, like this is the third year that it is being incurred, right? So if you do it 23.1, I don't know what's the examiner's interpretation. Maybe I might be wrong. Maybe you might be wrong. So like whatever happens, we're just going to lose 1 mark if we go wrong. Is that clear, Burton?
Yes, very much clear.
Right. Okay. So okay. So what have we done? We have actually gone through the economic value added, and we have also tried to do exam questions on the economic value added. I'll share with you people more questions on the economic value added also, but I'm just hoping and I'm just assuming that this whole session of the economic value added calculation would have been helpful and beneficial for you.
Sir,
Yeah, Christine.
could you take me back to the walk? I need to learn how to interpret. All right, you have deputy, the debt over equity equal 100%, and you have 1 over 1 plus 1. Can you just take me through
Elaborate
how
that?
you are? Yeah.
Okay. Now you see, you're gonna do it like this. Let me just guide you. Okay, 1 over 1 upon 2. Okay. See what happens is that debt to equity is 100%. That means debt and equity are same.
Okay.
Debt divided by equity. It's 100%, it's 100%. Is that okay?
Okay.
Now, if I talk about the debt upon debt plus equity, so what am I looking at? I'm looking at 100% plus 100 divided by 100% plus 100% plus 100%. So that means I'm looking at 1 upon 2. Do you get it now?
Okay. What if it was the other way around? Would be the
Like
same
what would have been?
if it was equity to debt.
Okay, usually you get the debt to equity ratio, right? So let's say if the debt to equity ratio is, let's say 50%, right? So what does it mean? This means 50 upon 100. You get my point?
Okay.
In that case, if you would have been calculating debt upon debt plus equity, you would have been doing 50 upon 50 plus 100. So 50 upon 150, it would have been 1 upon 3. You get my point?
Okay, just looking back on it. I haven't done F9, so I'm a bit
No
challenged
worries,
when
no
it comes
worries,
to
no worries.
this
Just
area.
means debt to equity means that what is debt, what is equity.
Okay.
Let's say if this is 1000, this is 2000. This means 50%. Do you get it?
Yes. Okay. Thanks.
Right? Okay. Anyone else having any other questions on this, please? Okay. So what have we done? We've actually gone through the economic value added. We have discussed how the economic value added is calculated. And I hope that you people would have enjoyed the session and you would have learned about the economic value added. Obviously, there are many exam questions that could be done. I've not gone through them, but I've just tried to do the economic value added concept and a question on that so that you people do have an idea that how to cover it up. So the recordings for the session would be made available to you and you people can actually have a look at it. So thank you very much guys for your time. Thanks for attending the session. In case if you've got anything to ask, you're most welcome to ask.